हम डिस्कस करेंगे एसेट एलोकेशन के बारे में, ठीक है? When I say asset allocation, what assets come to your
Equities, debt, gold, crypto are some things that come to mind.
one very important asset, especially for Indian investor, is real estate.
Real estate, yeah, insurance is insurance because we invest. We take insurance also as an investment in India, so
Yeah.
maybe in that, yeah.
I ask this question often to investors just to judge their understanding of what their asset allocation is, which they should be aware of.
Right.
My simple question always is, let's say if you own 100 rupees, if your net worth today is 100 rupees,
Mm-hmm.
how much of your money you think is in equity, how much money you think is in debt, how much money you think is in real estate, and how much money you think is in gold?
Yep. Yep.
Uh, Most of the investors would say 50-60% in real estate.
Mm-hmm.
Because even if he's a salaried investor, most probably his majority of the salary would be going towards an EMI for that real estate.
Right.
Then they say 20-30% gold, and most of them are not quite comfortable disclosing that. Real estate people still tell you about, but gold is something that people find more closer to themselves than this. Equity would be for a conservative investor as low as 2, 5, 10%. A very aggressive investor would have 10, 15, 20%, not more than that, barring
Right.
few exceptions.
Right.
And when you say debt, debt can be debt mutual fund as well as savings account balance, your fixed deposits, everything combined.
Yeah, absolutely.
So the second question comes is, what should be an ideal asset allocation and what are the factors that should decide your asset allocation?
Right.
So what do you think is an important factor to decide an asset allocation? Or a couple of factors if you can just quote, do you think is important to decide an asset allocation?
I think the first obvious one that comes to mind is age, obviously. Like at what age someone is, and let's say there's someone who's really, really old, maybe they'll have a much more conservative, stricter stance on where they invest money and what kind of returns they're seeking. But the other thing that matters, even if you're old, is probably your cash flow. So if, let's say, your cash flow is really healthy and your overall position is really healthy with respect to your expenses, even if you're old, you can take a lot of risk. It's not necessarily that you have to be conservative. So if you think of from a classical sense that you're retired, you don't have any income stream, maybe being conservative makes sense if your investment is there. But otherwise, you would have to look at it holistically, like where are the cash flows going, what's your income level like, and stuff like that. So yeah, that matters a lot.
Combination of both factors. Most people would suggest there's a thumb rule that your equity exposure should be 100 minus your age. That is just a point to sell an equity product mostly. There's no thumb rule as such. It depends from individual to individual, depending on what your requirements are. So for example, if your net worth is 10 crore rupees and you have to invest 5 lakhs, you can be very aggressive for that 5 lakhs, even though you are 70 years of age.
Okay.
So though your age is high, but the investable amount that you're looking for is very small proportion of your entire net worth. That might increase your risk-taking ability. But let's say you are a salaried person in mid-30s and you have, let's say, 2 lakh rupees per month salary. So going just by age, which would mean your equity exposure should be high. But you have 2 children, their education is there, you have a home loan to pay, you have a car loan and other debts, then probably your risk-taking ability might decrease.
Right.
So it depends. Also factors in at what your requirement is. I'll give that example. So this came down recently as a classical case to me. There is a family, both are retired people. So the male person is a retired businessman and the female is a retired government official.
Okay.
They had earlier invested about a crore, one and a half. Currently the net worth is, I mean the investable surplus is at around 1.5 crores.
Okay.
Now the lady is very conservative. So she is retired government official. So she is very conservative with her money. She doesn't understand finance much. So she doesn't want to take any risk and she's very happy with the fixed deposit interest or likes of it.
Okay.
Whereas the person who is a businessman, he is aggressive in nature and he is quite informed about the financial market. He is willing to take risks to an extent that, I mean, during this corona crisis, there's a lot of equity market came down. So he saw this as a huge opportunity to buy and invest, especially in equity. So, and there were 2 people who were behind him to kind of persuade him to invest. He invested through one of the distributor for 50-60 lakhs.
Okay.
Out of which 10 or 15 lakhs he had invested in equity and rest he has invested in debt. Now in debt also what he has done is he has taken long-term debt, like one particular fund.
At this time, debt. Okay.
Invested in debt, that is allowing him to do. and that too in a couple of funds. Like for example, in one specific fund of ICICI Prudential, he had taken the average maturity was about 7 to 8 years.
Okay.
So that is
Wow.
even worse.
Even worse, yeah. The currency risk, oh sorry, the interest rate risk is even higher.
Correct. So both these guys who were chasing him and persuaded him to invest, finally he invested through one of the distributors. And he said that I'm looking to, since the market is down, why shouldn't we try to time the market at this point of time and invest that 20 lakh also in the equity market so that we can leverage this time of buying.
Mm-hmm.
If you look at this entire scenario, as per his particular risk taking ability, he is an aggressive or moderately aggressive investor, whereas his wife is very conservative investor.
Mm-hmm.
The biggest challenge that I see amongst investors is not being aware about what they want to achieve with the money that they have.
Mm-hmm.
Now, there can be a debatable discussion about whether the opportunity is there in the market right now or not.
Mm-hmm.
But when I asked few questions to him, like I asked one question to him, which none of those guys asked him, as to what his goal was. Like he is
Right.
having 1.5 crore rupees today. So he gave me a ballpark figure. He said if this 1.5 crore becomes 2 crores in next 5 years, I'm very happy.
Mm-hmm.
Now I told him, did you tell the same statement to any other people as well? He said none of them asked me, but I don't think it is very relevant. Now just this small statement, I'll tell you the relevance of the statement in terms of asset allocation.
Mm-hmm.
If you do a basic calculation from 1 lakh, 1 crore 50 lakhs to 2 crores, duration is 5 years,
Mm-hmm.
which means about 33% return he is expecting in 5 years. It's about compounded 6% return in a year.
Roughly, yeah.
Take taxation into account, a 6.5 or maximum 7% return would be sufficient for him
Right.
to meet his goal.
Mm-hmm.
Now for 7% return, that's what I pointed out to him. For 7% return, it doesn't matter to him whether the market is at a right time or a wrong time.
Right.
I mean, the opportunity doesn't matter. Probably it is not an opportunity for him. Even if he invests in a conservative investment options, like fixed deposit, for example, is giving 6.5%.
Mm-hmm.
A senior citizen savings scheme which he can invest 15 lakhs, which no one told him about, is giving 7.4% return.
Okay.
Even the closed RBI bond, if he could have invested, it gives 7.5% return.
Right.
Point being, without taking undue risk, he can still achieve his goal of 5 years.
Exactly.
So for him, even though his personal risk appetite is high, he is okay to take exposure into equity.
Mm-hmm.
The requirement doesn't suit him to take that much risk.
Yep.
So most of the people, I mean, all of the advisors have a topic called asset allocation, whatever study you do. Most of the investors who are aware have heard about it, but these basics are when people don't think of while actually applying investments in their real scenario.
Right.
So say if 7% is also not achievable, let's say if you are putting the money in FD, which is giving 6% return.
Mm-hmm.
Even by that calculation, instead of let's say 5 years, the goal might come in 6 years.
Right.
Will that make any difference to your lifestyle?
Yep.
And is it worth waiting for 1 year or taking that in extra risk to lose your sleep over it if the market goes down again?
Yep. Yep.
So finally, his wife was very gung-ho about all this said, and she said, "Okay, that sounds cool. A, I don't have to take undue risk.
Mm-hmm.
B, my husband's BP need not to rise when markets fluctuate. C, I don't have to run around people looking for advisors, looking for various people across the market to look for good or bad advice. And I can just keep my money somewhere safe, especially with these government decisions, and do whatever I want and read or listen about this theoretical concept of asset allocation. People usually just think of it as a very small concept, but it plays a huge role in. This is one example. The second example that I had is investor. He's a businessman. The investment decisions are taken by his son. The money is of father. And this is about a couple of years back. Market was going slightly on the bullish run. So as an asset allocation strategy, equity exposure should be high for him. A small amount of debt exposure would be a decent enough asset allocation. But as a practice, it is always advisable to have some exposure to an alternate asset apart from your core investment philosophy. So for example, if you are a conservative investor, still you can afford to have some 5, 10, 15% of a slightly aggressive asset allocation. So for example, you can have a hybrid fund, large cap equity fund, index fund and stuff like that.
Right.
Just to probably optimize your overall return.
Okay.
And similarly, it is for aggressive investor also. So if you're a very aggressive investor, still it is advisable to have some exposure to debt, like 10, 15, 20%. It serves two purposes. A, it serves as a cushion if the market falls down a lot, your portfolio will slightly be benefited out of that debt exposure.
Right.
Plus, it gives you a buying opportunity also. So if equity market falls down, you don't have cash, you can pull that money out of debt and use that in buying that equity and making it price, averaging out your buying price.
Basically, rebalance your portfolio, right?
Correct.
Yeah.
So that's the objective of asset allocation. But when we had this discussion, he said, no, I'm very aggressive. I have a lot of cash flow. So let's go all out with equity. I mean, as an advisor, be it a distributor or a fee-only advisor, you can only advise or put options in front of your investors or clients.
Right.
Ultimately, they have to decide on their own. So finally, we decided to go ahead with all the equity, 100% into equity.
Oh, wow.
And that to primarily invested into diversified multi-cap, mid-small cap segment. Right?
Oh, okay. That's pretty aggressive.
Now the funny part is when the market started to come down, and when the markets came down crashing a couple of months back, he panicked and he said, "Okay, let's try to book loss and get out of equity." Then I reminded him, oh, but we had a discussion a couple of years back that we are not going to touch this money for 10 years. On the contrary, I would suggest if you have some money elsewhere or if you have some cash flow, probably we can try to average out the buying. Anyways, we have a very aggressive investment horizon. So I just tried to make him understand the basics, which obviously he didn't understood. Many a times we keep on quoting various people, big time investors, about this famous quote. So I just told him one thing, you should be greedy when others are fearful. But again, these are all theoretical things. It sounds very nice when spoken in theory, but when you have to apply in real life, it's a different thing altogether. Right. We could have rejigged the portfolio. Like for example, I told you there was small allocation to a balanced category or a small allocation to a large cap category. We could have pulled that money and put it to mid cap category if I was an aggressive investor. But then he eventually panicked out and he withdrew money from the investment, anticipating that the market will go down further and I'll buy at that point. And it never went down below that price.
Okay.
So the point is, now for this specific case, if he would have stick to the basic asset allocation at that point of time itself, A, the loss that he would have very much less as compared to what he actually had, and B, if he would have put some money into debt, he still would have got an opportunity to buy at a lower price and average out his buying price.
Yeah.
So the point being, though it might look like a simple concept of asset allocation, it might look like a very theoretical concept, but the application in day-to-day life is very important. So, and when you do any kind of financial planning, any kind of personal finance or advice, these basics hold true for all investors. So, often when we talk to investors, it seems very boring to engage an investor for about 10-15 minutes on such a small basic topic. And these days, investors want to listen about very fancy, very fancy, very a topic with a lot of jargons, technicalities, and so they like to listen these kind of stories, so to say. But ultimately, any basic concept is what saves you in tough time, right? So that's how things are in the current scenario. Probably my only suggestion to investors would be to be more aware, to be more informed. Don't undermine the basic concepts that are there. They're there for a reason. So, and even so, as we discussed last time also, for a good investor, you need not to have a lot of fancy ideas, a lot of sophisticated products to have in your basket to get those extra returns. It boils down to these basic concepts such as asset allocation, investment strategies, your objective of investment, your risk taking ability, and stuff like that. So those are very important things that one should keep in mind.
Actually.
Correct.
Cool. Nice discussion. We'll probably move to a much more smarter format going forward. Let's try that.